Hello and welcome to my YouTube channel. There is the backbone of everything. We learn a lot of things: psychology, market, mapping. We also learn about the trend. There are so many things that we need to mark to run. But the great core, or the backbone of everything that we look to learn, is how the market is moving. And the market moves in two main phases, or we can say three, but the main one that we look into are the bullish market and the bearish market. In a bullish market, we expect price to create highs and lows, and in a bullish market, when price breaks this level, we know that it is likelihood for price to move to the next high, creating a new high. In a bearish market, we look for the bigger trend, and we look how the market is trending down, creating lower lows and creating lower highs consecutively that way. So as a trader, how do you spot this? So today I'm going to discuss about structure identification. How do you identify the structure of the market, and how do you trade depending or according to the structure of the market? So with this topic, we are going in trading, or we have different concepts, we have different structure that we learn, different strategies, but the main ones that I'll be explaining in this topic, we are going to discuss about break of structure, change of character, major highs, strong highs and weak highs, strong weeks, weeks highs and weeks low, also a varied pullback. So these are some of the things. We might not discuss all of them in this one episode, but if you follow my videos, you will get that I'll be in a position to explain each and every structure, each and every strategy, each and every formation of the market, so that we can have an edge, so to know which is the best time for us to trade. If you look on this structure, we have said we have two main trends. We have the uptrend and we have the downtrend here. So in an uptrend, the market creates high and lows, and then when this high is broken, this we considered it as a break of structure. So the abbreviation of a BOS is a break of structure, and this one is a high. We considered it a new low when market breaks the previous high. So when the market is moving up, we mark this as a higher high and this as a higher low. So higher high, when the market breaks this previous high, we consider that the market is bullish and the trend is uptrend. And then after this pullback, we have the market is moving on an uptrend. So we are going to discuss also, as you look on the downtrend, the market creates lower highs and lower lows, because the low is the one that confirms the lower highs, and we confirm a lower high after a varied break of the lower low. So in the forex market, we are mostly interested in the trading market. That way I told you, because we have a phase that we call consolidation, where the market has not decided on which side it's going, and this most of the time is unpredictable. So this is, if you ought to trade this consolidation, you have to do a lot of research, a lot of confirmation, but most of the time it will give you a false indication, because the market is consolidating, or maybe creating highs and lows that are within a specific range. So we have said that we are interested on the bullish market, and the bullish market is when the market creates highs and lows, and then in a bearish market, the market creates lower highs and lower lows, lower highs, lower lows consecutively. So this is the trend that we are looking for. we don't go into the market just to trade because we have seen a structure, but first of all, the thing that we should look for is to identify where there is a valid break of structure, or the first thing to do is to identify the structure of the market. So most traders do it long. They just find an opportunity, they just get into the trade, they don't know even where the trade is going. And we say that you have to know that the trend is your friend. Be friend with the trend. Always follow the trend that is dominating in the market. Then you have been learning about this concept in the market, or maybe how to trade, and you have come to realize that in a textbook, or what you are being represented on a drawing, is a very smooth market structure. Here the market created a low, created a new high, and this is in a textbook, meaning that whatever you see on the textbook will be very different with whatever you see on the little chart. Why? Because in this textbook explanation, you see very smooth. This setup, nobody can, even a child would see them and would trade them. But this is how is just a representation of how price goes. And then what you should look for when you get into the market, mark the highest area and the lowest point before the market broke structure. This will be the one that will be guiding you, because if you look into the market like here, you'll see that the market is forming some trends within the bigger trend. So make sure that your focus is on the trend, on the highs and the lows that are created, and then whatever is within this range is what we call internal structures. And these internal structures, we are coming to know, or to see how we are going to trade them, or maybe how we are going to use them to get into trade to minimize our risks and maximize our profit. So don't be confused by these small structures that are inside the market. Their work is just to form either pullbacks, or maybe gives you an indication that the market is have exhausted the sell, and it is probably going to give you an opportunity to buy. So this is how you look in the market. Don't concentrate on the internal market, just look on what is happening on the highs and the lows of the bigger trend. This is a bullish market example and a real explanation of how the market works. If you'd look here in this example of a chart on Euro USD 1 hour time frame, you see that there is a break of structure here, and there is also another break of structure. This is the highest point, so a break of structure here, and also another break of structure. Why are we considering a break of structure? Because the market, when it is moving up, it was able to close above the previous high. So this is the valid break of structure. And if you look into the internal of this market, you will see different structures. You will see that the market created a low, broke that low, high, created a low, created a high, broke that high, then the market started consolidating. If you then it broke this high, went down again, broke this low, and then moved up to create the break of structure of the bigger trend. So if you don't concentrate on the bigger scale, on the bigger picture of the structure that are being formed, you'll get yourself messed up, and most of the time you'll get yourself missing trade, or maybe getting into the wrong trade. So ours is to create a strategy, or to look what the market is doing, and then now we base our trades according to those structures. So in a bullish market, we have said that the market creates higher highs and higher lows. So if you look here, this is a representation, or in this representation you'll see that this high formed a low here, and the lowest point price had reached. If you look here, we have this low. This is the lowest point price had reached before it broke a structure here. So this is the pullback. Then price broke structure. You can see we have another pullback. After price broke structure again, we have a new high, and then this new higher low is the one that constituted this break of structure. So these are the points that we should be looking for: this high and this low. Anything that is being traded inside this structure here is for the minor structures, and these are one who gives us confirmation how the market is going. So your eyes are not trained to see specific details, but you have to train yourself to see that, because those small details that we tend to forget are the one that will cost us most of the time, are the one that will cost us if we don't look to the details. So most of the retail traders trade after break of structure, and they put their stop process below the low, the support. According to SMC, you should wait for a deeper pullback. You can use the fib tool. So what I mean by this statement, that for most of the retail traders, if they see a break of structure, they jump into the market and they start trading toward the trend of the market, and then you find that they'll put their stop loss below the support, which has been below the resistance that has been broken. And this is very long, because the big companies, or the big firms, or the smart monies as we speak about them, they know that most of the traders will put their stop loss below these areas, and after they have put their stop loss in below these areas, they are targeting higher highs. And that's why you see that most of the time you'll get that the market will move in your direction for a while and then comes and takes you out. And this is why we need to have to see a varied break of structure. Then we need to see price comes and takes the liquidity areas. All these we call them inducements. So you wait for inducements to be created, and after the inducement has been created, then you have an opportunity to get in if the market gives you a confirmation. So not necessarily that the market will retrace below these areas, but you have to mark your areas where you are expecting that the market can shift and give you a strategy. If you look here, there's those people who bought after this break of structure, and they put their stop loss below this low. We're expecting that the market will continue. Yes, the market will have to continue, but before it continues, it has to do a deep retest. If you can look, the market continued lower and stopped out all those people who had put their stop loss below these support areas. And then that is how you should be very careful when trying to trade, because you need to have first of all to identify inducement, and then identify areas of value for you to get in with the market. The next thing you should do is to use the fib tool. The fib tool, these are a tool provided in all platforms. It's called the Fibonacci. So in retracement tool, you should use your levels. After a break of structure, look for the lowest point and the highest point. Then on the fib tool, there are the levels. So if you want to learn about Fibonacci tool, you have to check on my upcoming videos, because I'll be discussing about how to use the Fibonacci tool in your trading, and this will also sharpen your entries, and you will not be getting into entries that are not confirmed with the Fibonacci tool, because it coincides with the levels like order blocks, fair value gaps, swing highs and swing lows. Most of the time it creates dynamic resistance that coincide or are in conjunction, or gives you a confirmation that now it is time for you to get into the trend. So observe those lows. This is in a bullish market. If you can look in well, you'll see that if you are not trained well, or you have not trained well, you'll be confused by these choppy structures that are happening inside this market. So if we go to a bearish market, the same scenarios unfolds. Price breaks low, creates a low, forms a lower high. This is a pullback. Continuous breaks low, forms a new lower low, pulls back, creates a new higher low, a lower higher low, and then this higher low is confirmed when price breaks this structure here. So we have a new lower low. This higher low is not confirmed until price breaks below this level. So that is a representation on the book. If you go to the market, this is what you'll find. Price is creating highs, then comes and breaks structure. This we call change of character, and then this is a small pullback. If you go to the lower time frame, depending on the time frames you use for analysis, you'll get that we look to these areas so that we can have a good opportunity to get for a sniper entry. So after this row is broken, we don't get in until you get inducement. This is areas of support resistance that has been created, but we see there is an area of value ahead above them. So this is where we wait for price to take out these areas so that we can have an opportunity to go short and to have a good risk to reward ratio. This one we are going to discuss in the upcoming videos on how to get entry models using the smart money concept. So, and the order after discussing about the order blocks, mitigation order blocks, breaker blocks, and how to top down analyze your market from your higher time frames and to the lower time frames, and which time frames to use to analyze the market for you to have a better risk to reward ratio. So this is a good representation of the market in a bearish market. If you can see, you don't look keenly, you'll find that the market will give you false structures. So this low is the lowest low, and then the market give you some structures but created a new high. This is called it the lower high, and then after that the market came and broke this low here. After breaking this low, this is what I said, wait for these inducement levels. This is an inducement level, creating, you can use it as a trend line. Also you can mark the highs that has been created. So anybody who took a short here, putting the stop loss above this resistance, yes, they have some happy moment, but the market reversed on them. Why? Because we had an area of value that price had to go to for it to continue down. So if you want to run, you have first of all to be keenly checking on what the price is telling you. So don't rush in to get into trades because the market has broken structures. So don't rush in to get into trades because you have seen a break of structure to the downside. Wait for the market to create areas of value and show you that this is the level that I want to get in. This is a fair value gap that had been created here, and if you look very well, we have an order block here, and this order block was mitigated. After price mitigated this order block, you could get in here either directly and put your stop loss above this high, targeting this row, or going to the lower time frame depending on your analysis lower time frame to find sniper entries. So again, these are structures that will teach you in the upcoming videos, so stay tuned to my YouTube channel and you will find a lot of value in the videos that I'm going to post. So if you have not subscribed, this is the best time for you to subscribe to my YouTube channel. Click the notification bell, and also like and comment. You can put your comment on the areas that you would like me to discuss with you. So if you can look here, most traders take trades off after a break of structure, what I've said here, and they place their stop loss above this high. You see what happened, the market did? It took them out and then continued down. As you can see, again, this row was created after there is a break of structure here, and these are areas where people got short. So price broke structure, someone got in here, their stop loss, they put them there. Then price continued creating equal highs, and then people got in expecting these resistance areas to hold, and see what happened. The market took them out. After taking them out, it continued down and broke structure. The same happened. Never get into a trade without having to see this liquidity area. So the next episode, I'm going to discuss what is liquidity and how to avoid being trapped by the liquidity areas. Then with that, you'll be taking trades that are of high quality, and most of the time you'll get that even if you miss a trade, you have missed a trade because it did not give you the structure that you are looking for, and because it is not 100% that this structure work, because the market can change direction depending on a lot of things. First of all, we can have the market can change direction because of the news that we call fundamental economic structure, economic announcements that maybe affect the behavior or maybe the direction of the market. So what you need to do is to be keen on how you get into a trade, but make sure that every trade you get in, you use your rules so that you don't go in and out making losses that you are not that you could have avoided. So as we have discussed, in the next video, upcoming videos, I'll be explaining how you are able to identify the best areas for you to take trades and which entry models do I use in my tradings, and which levels are the best for you to trade. Also, I'll be explaining which tools do you need in your arsenal for you to have a better risk to reward ratio, also for you to have a set of rules that you can use. So remember, you need to first of all have one thing in mind, to look for the trend of the market. That is the best thing and the first thing you should do when you get into the charts. Then after checking the trend of the market, now try to identify the structure that are being formed. With those structures that are being formed, then you are able to identify your areas of value. In those of the areas of value, we say that we need to identify our order blocks, fair value gaps, also levels in the Fibonacci tool, which I'll go to discuss in the upcoming video. So thank you for your time, thank you for your support with my YouTube channel. Continue subscribing, liking the videos and commenting. Also share the videos with others so that they can learn, and then you can comment which or what strategy you want me to show you on how you can trade. Remember, these structures we are running, they work mostly on all commodities and all assets and all currencies pairs. So it is you to choose which strategy is working on these pairs, which strategy is the best for me to use on the next pair. So if you keenly watch, you'll have a set of strategies that you will use on different pairs. So stay tuned, because I'll be analyzing, and every strategy I'll give you the best pairs for you to be trading on those strategies. So watch my videos, like, comment and share, and until we meet on the next upcoming episode, stay tuned. Bye bye.